If there's anything you take away from this conversation, it's the ruse of the gurus and the DIY trap is you spend all that time to get into one more investment strategy, one more asset class. And that's not financial security. You may have financial, quote, independence for now, but you don't have resilience to market swings. The only way, it takes 5 to 10 years to become an expert in something. And if you're going to get into a dozen different, completely different investments and build true resilient wealth, it's going to take you multiple lifetimes, which you would have to sacrifice all your time from your family, friends, and hobbies to become experts in so many different strategies. It's just not plausible. It's not healthy. It's not the way to build a balanced lifestyle.
What if the safest investments aren't on Wall Street, and the next recession could be your greatest opportunity to build generational wealth? Welcome back to another power-packed episode of the Real Estate Roundtable, the show where we break down the strategies, the markets, and the mindset behind wealth building in today's world. I'm your host, Lancelot Lenard, top producer with Florida Homes Realty and Mortgage and leader of the Sir Lancelot Group, bringing you real insights from real experts shaping the future of real estate and investing. And today's guest, he's someone who's redefining what it means to build wealth in any economy. Joining us is Patrick Grimes, founder and CEO of Passive Investing Mastery, Amazon best-selling author, and visionary in recession-resilient investments that help busy professionals escape the grind and build secure passive income streams. You like that, don't you, Patrick? From engineering boardrooms to boardrooms of multi-million-dollar investment strategies, Patrick has unlocked the formula for diversifying beyond stocks and traditional real estate and into alternative investments that thrive even when markets don't. This is going to be one of those episodes, listeners. Replay, so let's dive in. Patrick, before you build this massive platform around passive income and recession-resilient investing, where did that journey really begin for you?
I appreciate you having me. I started out just like many of your listeners. I was a high-paid professional in corporate America, slaving away. I did machine design, automation, and robotics. I had a bachelor's of mechanical engineering and a master's in engineering and an MBA, and just slogging away, started learning how to diversify, learning how to invest elsewhere, and that's how I got started.
Was there a moment, frustration, a loss, or a realization that pushed you to look beyond Wall Street?
Actually, it was interesting. So when I first started out, I was doing automation robotics, and I talked to the founder of the machine design firm, asked him where I should invest because I started making bonuses, was eager to do something financially wise with my earnings. And he's the one that pointed me away from the high-tech startups. I thought he was going to say, go invest in this gizmo and this gadget and this startup, because we were right there in that San Francisco, Northern California Bay Area doing a ton of work. I thought for sure it was going to be startups and stocks. Turns out it wasn't. He said alternatives in real estate. You make your money in high-tech, spend it elsewhere. So that's what got me originally on the path into alternatives.
Oh, awesome. You often speak about wealth building beyond traditional real estate. What opened your eyes to the world of alternative investments?
Take a look at the allocation strategies. Any published data about how hedge funds, family offices, private equity, sovereign funds actually allocate. It's not all in the stock market. It's not all in real estate. It's not all in bonds. In fact, about 25%, 24, 27% on our slide decks, we show a couple different allocation strategies of different groups out there, but they show that's really where that real estate is. So then what else is there besides the wild ride of the stock market or the bonds, right? So what else is there? And so you look at, man, is there other asset classes? Sure, there's things like oil and gas, right? It's another allocation. It doesn't ride the same waves as real estate or the stock market. We call that non-correlated, different market fundamentals. But man, that one, it goes for a ride. So what are some of the other ones? There's medical, right? There's the legal industry. There's education. And those industries actually don't go for wild rides. They stay relatively stable. We call that recession resilience. in addition to being non-correlated. They're not relying on the same market fundamentals. And so when you allocate into those strategies, those are when you start building true stability, what we call resilience or security, not riding the same waves the majority of your portfolio.
Gotcha. That's really interesting. I didn't even know education was a place where you could invest. That's pretty cool. What was the first aha moment when you realized diversification was the real path of freedom? Freedom! Like, you probably jumped up from your chair, Mel Gibson, and just shouted, freedom! So what was that aha moment?
The first one I already talked about. The second one, when I realized real estate wasn't the end all, was when I lost everything in 2009 and 10. Say I was investing, but I was more speculating on some higher risk pre-development. I was personally guaranteed on a loan, and then the subprime mortgage collapse happened. But so I realized, hey, look, you can build wealth, and more millionaires were created through real estate than any other industry. But you can build wealth in it. You can also lose wealth quickly, and that's when, man, I realized you got to do it right, and you got to be in more than just one or two industries. And in fact, just in this during the post-COVID era, we saw commercial real estate take a downturn, just like we saw residential real estate take a downturn back in the subprime mortgage collapse. Values dropped 20, 30%. So you can't just be all in one. So the challenge is when you get really good and comfortable at something, that is not the end game. That is one stepping stone. And you got to keep learning to partner, learning to continue to grow, stretch yourself, educate into other lesser known asset classes.
That's super interesting, my friend. Every investor faces risks, but you built a model that thrives in downturns. What did you learn from the difficult economic cycles that shaped your recession-resilient playbook?
Questions, and your bio was one I hadn't quite heard said. The time and effort into these, which is great. What I'm doing isn't necessarily magical. What I'm trying to do is try and share just the basic fundamental concepts between allocation strategies. Not, hey, I'm really comfortable in the stock market, so let's be in the 50 different stocks. I'm educating on our platform. Here's the 50 different alts, completely different alts you can invest in outside of stocks. And we're offering those investments out there. And we're saying, look, here's how they vary. Some are cyclical, some are market dependent, some aren't. And here's how you can slice up pieces of your pie chart. And each time you do that, and it's actual diversification into an industry that doesn't rise and fall with the rest of your portfolio, that has fundamentally stable economics, that helps you sleep better at night, helps me sleep better at night. It doesn't mean I've come up with the special way to do this that nobody else has ever thought of. It just means I'm trying to make this knowledge available for those accredited investors out there that are hardworking just like I was, but was never educated, never was given a clue as to how to even access or know about these alts, these lesser known alternatives, and how to access them and start to build more pillars of wealth and a more stable foundational portfolio.
Patrick, what would be really cool, I just thought about this. I always get these ideas when I do a podcast. It would be cool if we could come up with a curriculum that we could teach high school students at the early age how to do these things throughout their lives and how to start little and then grow it and then become a big investor like yourself. I don't know if you ever thought about that, but that would be pretty cool. I'm pretty sure it might have crossed your mind. How did your transition from active investor to becoming one of the go-to strategists for passive wealth? How did that transition happen?
So there's a couple things that happen, right? When you get out there and you're like, okay, I'm going to start trying to figure out how to build wealth. A lot of the times you do what I did and you dive out there and try and do something yourself. And while you're maybe a successful engineer or lawyer or doctor or director of something, and you're thinking to yourself, hey, I've gotten really good at this. My ego tells me that I can also be the expert at this next thing, right? And so I call that the DIY trap. And I fell into it numerous times. The first time I actually lost everything in a downturn. And then the second time I was successful at single family investing, called the Burr method before I knew what that was, but buying, renovating, refining, renting, and repeating. But this method was successful, but I lost all my time. I lost my life at that because I was taking all my time away from my family, friends, and hobbies, moonlighting real estate by doing and doing engineering during the day. So what really happens is you kind of get caught in this DIY trap, or you get caught in this guru trap. I call it the ruse of the guru, because I've done that before too. I paid a lot of money for a guru program to teach me how to become the expert in this one thing. And what happens in all of these cases is that you dedicate so much of your life, you trade away so much of your life to become a slave to your investments. But in order to get really good at that one thing, you give all that away, and you only are good in that one thing. And if there's anything you take away from this conversation, it's the ruse of the gurus and the DIY trap is you spend all that time to get into one more investment strategy, one more asset class. And that's not financial security. You may have financial, quote, independence for now, but you don't have resilience to market swings. The only way, it takes 5 to 10 years to become an expert in something. And if you're going to get into a dozen different, completely different investments and build true resilient wealth, it's going to take you multiple lifetimes, which you would have to sacrifice all your time for your family, friends, and hobbies to become experts in so many different strategies. It's just not plausible. It's not healthy. It's not the way to build a balanced lifestyle. So it does take the ability to partner. It does take the ability to not become the active doer in all of your portfolio. You've got to learn how to allocate, trust and verify, and work with partners passively to be able to allocate into completely different investment asset classes that are hard to understand, a little bit new, and you won't have a lot of control. Why? Because you don't know about it, and that's okay. The goal is when those returns come back, they won't be dependent upon the ebbs and flows of the rest of your portfolio. And that's how you do it. So it really comes down to having to learn to partner and then finding that balance of living your life and building a resilient portfolio in a dozen foreign kinds of investment.
It's pretty much the same in business, man. I run 3 businesses myself, and I'm the one guy with all the hats on, and I'm just branching out and learning that experience of employees. Oh my God, this is awesome. I don't have to be there physically and do the thing that has to be done. I can hire someone to do that. It's pretty much the same what you're talking about in investing. It's like you're not doing the physical thing. You're putting your money in it, and somebody else is doing the active work inside that investment. And I think that's amazing because that's different scale. Like what I'm talking about is like your small scale business. You're trying to grow it. You get an employee here, an employee there, and then you could get more jobs, et cetera, et cetera. But you're talking about bigger and bigger because now you're doing big investments compared to, hey, I need a handyman to do that job for me, or an assistant to make me write up the stuff for me. So I think this is amazing. Like you took Robert Kiyosaki's cash flow quadrant and made it into this amazing thing, in my opinion. I didn't read that about you. I think that's how my brain works. Let's talk a little bit about litigation funding. It's something that most investors have never heard of. I never heard of it. What pulled you towards that? This is an incredible, unique asset class. And how does that work actually? Just you explain, please.
Mentioned earlier that if you're really wanting to build resilience in your portfolio, you've got to get an allocation in the stock market, bonds, into real estate, and elsewhere. Where are those other elsewheres? You got to spearfish them. And so the ones that are highly attractive to me are in legal and medical. And why is that? Just for the same reasons I invest initially into Houston in real estate, was it's very steady growth. Healthcare, doctors are busy in good times and bad times, and it turns out in the legal industry, similarly, when good times are good, people are investing in using attorneys. When times are bad and people get litigious, people are still investing in attorneys. It's what we call a non-correlated industry, right? Those recession-resilient attributes to it. So when you're looking for, hey, look, it was like 5 or 6 years ago that I was talking to them out there looking for different kinds of lesser known investments, which are highly coveted by, again, these private equity, hedge funds, sovereign funds. Litigation funding is one of them, and it's been around in America. The big one was 1910 when American tobacco was poisoning people, and people rose up and funders helped get them access to justice, and they won a big settlement over American tobacco. But it's been around for a long time, and we're looking for those industries where you're providing a service, just like in our real estate deals. We're either lending to real estate operators in one of our funds to house tenants. In our legal fund, we're lending to contingency fee-based attorneys. We're investing in those attorneys to allow and enable a contingency fee-based representation. It's not for free. It means that they've got a lot of skin in the game. They've been working on it. They believe in the case, and they want to provide access to justice for those that otherwise couldn't afford it. And we can enable that by financing the legal proceeds, the litigation for them to get through the system and get to settlement. And it's the same in medical. It's why we're into medical as well. There's doctors out there that have done services and they're trying to get paid. And there's a gap in our healthcare system where it's just a long duration, some short-term, 30, 60, some long-term, 2 to 3 years. And we can provide a service and help give those doctors access to funding now for their receivables that could come later, and they could reinvest in growth. They could reinvest in new people and equipment. And so it's financing and funding doctors. And both of those provide a service which does some good along the way. It supports very necessary and critical industries. And you get to participate in really solid, non-correlated returns as an investor.
What are the returns of something like this? Is can you like a percentage wise? Is it like your regular IRA, or is it more a bullish stock? What is it like? Tell me a little bit about it. Like, what's an average return on investment on litigation or medical?
It's like asking, hey, what are the average returns on real estate? There's 1,000 ways to invest in real estate or oil and gas, right? And so in any industry, there's a continuum where you can invest really early on and go for really high and high risk returns, like I did in real estate and pre-development and lost my ass, right? Or like wildcat oil and gas drillers, they'll invest really early, speculation, or angel or seed investors, right? Where things are not very well known. But later on, call it late staged, things are more calculated, and you can go for a more reasonable risk-adjusted return. And funny, that means, okay, the case has been around for a while. It's gone through the trials. You've done discovery. You've seen, is there culpability? Is there liability and causality? Is there really a case? Are they already talking about settlements, or have settlements already been published? And then how close are we to the finish line? Are we really close? Then you're not going to get astronomical returns, but you're not going to take huge amounts of risk either. And so we, in our specific fund, call it a single event or late staged, what we call mass torts, nearing the finish line, we can clip about a 20 to 30% projected IRR in those funds, which is
that's an awesome return, my friend.
Highly diversified across thousands of individual lawsuits, lots of case types, and we call it a litigation portfolio. So it's a lesser known sort of novel asset class. The returns have not been priced out of it, like in so much so in real estate or the stock market. You can get a great, what we call risk-adjusted return, just like in medical. It's not super busy. Not everybody's doing it. So you can still find yourself a good return for a reasonable risk.
That's pretty cool, my friend. I never heard of that, and I really like it. I read a lot of Tony Robbins. I'm pretty sure it's in one of his books and about diversity. We're investing into funds like yours that are diverse in all these things. You talk a lot about building freedom, not just wealth. What does passive income mean to you today compared to when you first started?
When I first started investing, I tell you what, I'm still a geek. When I was a kid, I was building Legos. And when I went into my adulthood, I was just building bigger Legos, robotic automation cells for really cool satellites and EV and defense and heart valves and catheters. I was building so much. I never thought that I was going to leave being an engineer. Never even occurred to me. I thought, oh, it's just going to maybe accelerate my retirement and or build enough wealth such that I would have leave some back. But I never thought I'd stop engineering. It was interesting as I grew over the years and I started realizing that the original advice I got was make your money in high tech and put it elsewhere because that's where you're going to have the security for your family. That started to ring true more to me. And I started realizing that, man, if I succeed at this, maybe I don't have to travel for work so much. My boy's almost 3 right now, and I'm able to be home a lot. Right. And I'm actually be able to be home, or I'm able to be with my parents where I'm not right now. Doing dump runs and working around the house and installing the fan above me, just helping out my parents. And otherwise, I didn't have that kind of freedom before. Location freedom. My wife and I, we live in Hawaii. It was her idea during COVID. Let's just move to Hawaii. I guess that's something we can just do. So we did. And it's been beautiful. We spent time back and forth until we just decided to make it permanent. Location freedom. And so I think that the difference becomes you start to make choices about what you want to do with your time versus what you have to do with your time. And that changes. And I get to launch a platform, give back, like passive investing mastery. It's my blue ocean approach at educating aspiring investors like I once was who knew the 50 stocks but had no idea anything else existed. We have a platform presenting every different kind of alternative investing strategy we can uncover, from cannabis to timberland to gold mining to forex to every kinds of real estate to bourbon barrel cask investing to pilot education to buy a plane for cash flow to everything we can come up with. We bring panels of people and educate and help raise awareness, show that they're out there and available, and give people the opportunity to get more comfortable over time. And those are the kind of things that I love. I love doing that and talking with investors, getting them pointed in the right direction that I otherwise wouldn't be able to do if I was slaving away still doing contract engineering work.
Wow, that's incredible. And what's the next evolution for passive investing mastery?
We have a plan right now to launch a different non-correlated alternative each year. So we have acquisitions in commercial real estate. We have private credit lending to commercial real estate operators. We have litigation finance to attorneys. And now we're doing essentially medical finance, funding doctors and practices. We also have a wealth accelerator where we're helping to educate people along their journey a little bit faster. That helps not just bring awareness of non-correlated alternative investment strategies, the 50 some out there that we've already zeroed in on, but it also teaches asset protection and tax strategies, tax efficient wealth building, these things that are really, there's nowhere to go. There's really nowhere to go to learn this stuff. And so we teach all of that stuff. So I think that probably covers it.
What future trends in alternative investing has you most excited?
So a lot of what we call private credit strategies. These are things that tend to do well in downturns. Private credit tends to take a big step forward every time there's troubled markets. And so as the banks pulled back during COVID, we were able to pull forward and provide that gap and bridge loans, a little higher interest rate, but fulfill that market. We're able to do the same thing in legal, where you have an investment which is much lower than the collateral value, right? Just like in our debt funds. And then same thing with medical, much lower funding on receivables than the total value. So you have this ability to invest at a lower risk premium, a lot of cushion for volatility. And what excites me is the ability to be able to continue to do those kinds of investments in an environment where things are really uncertain right now. Interest rates skyrocketing, inflation is looming, our economy's struggling right now, especially if you subtract out the overspending for AI infrastructure. Our GDP is down towards at or below 1%, and a quarter of that's propped up just by our own spending. So you add that to the global wars that are going on right now and the trade war that's going on right now while the world's biggest economies are betting against the US dollar. I think that's all stuff to calculate. It's not stuff to sit and worry about because you can't worry about it, but it's stuff to take action on. It's stuff to say, look, should I think a little bit tonight about my pie chart of my allocations? Should I think about where I should put my next investment to begin to invest? And so what I look forward to and what I is trying to be part of the solution there, trying to offer alternatives, which you don't necessarily have to worry about all this global macroeconomic uncertainty because you can allocate into strategies which tend to survive or thrive in those kinds of scenarios. And that's really where my focus is right now.
What are those strategies you're talking about? Can you elaborate a little bit on it?
I've been elaborating, yeah. So you do an allocation strategy from real estate, equity, and debt, because the debt side is getting a lot of cushion. Industries that we call non-correlation and recession-resilient is a Venn diagram, and then I add to it AI disruption, right? So I want to make sure that there's an insulation from immediate AI disruption. So I'm not investing directly into blue-collar workers, which can be immediately replaced, but things like housing, you're still going to need housing. Operators are still going to need debt. People are still going to need rent. and legal funding, attorneys are still going to need to be funded to provide access to justice. And medical, they're still going to be doing MRIs and surgeries. They're still going to be solving harmed people's problems through giving medical care. And there's still going to be a gap in the timing that the insurance or the underlying pays will pay them. So those are a couple of the strategies. But then again, you also look at some other things like oil and gas, right? There's cash flow and royalties, and there's tax advantages and wealth building and direct oil and gas drilling, call it working interest. And so that turns out an allocation. It's not the end all, it's not something to get over allocated into, but that's another allocation. Got to have the stomach for it, because that one does ebbs and flow at time, but the ebbs and flows are not the same ones that rise and fall. I'm into metals myself. I'm not necessarily a ton of exotic technology metals, but many years ago I invested into gold and silver, and I'm doing great, right? And if I didn't have gold and silver today, I would buy it today. People are like, oh, it's too high. But I'll tell you what, it's a hedge. When I bought it, it was high too, but I knew I needed to make an allocation, 5-8% allocation. And the cash reserves I have, the inflation is drawing down the value. The whole time inflation has been drawing that value, I've been making it up in my cash equivalents, in my precious metals allocation. And they're killing it right now. So I feel a lot better about my cash on the sidelines because I've hedged it against other cash equivalents. So I think that's a really important piece as well. We could probably talk all day about,
I want to keep talking.
things.
I have one more question on this topic. You mentioned AI for a split second there. What are your thoughts on this? I'm heavily invested in AI. I think it's the future in a massive way. I think it's a definite disruptor. I think it's bigger than a .com in what I've been reading and seeing. What are your thoughts about AI and AI stocks and AI investing? And what would you do for AI investing if you would do some AI investments?
Wild. I was just reading this morning trying to wrap my mind around the total investment in AI infrastructure specifically is actually propping up the majority of the GDP of this country right now. And when you strip all that away, you're at sub 1%, especially if you take out just what's propped up by government spending. I was looking at the numbers. I thought it was like 20 billion a day in AI infrastructure is what NVIDIA is saying. Or sorry, it's saying per week. And then you're talking like over 50 weeks. And that's what NVIDIA is saying. But you look at between Amazon, Google, building out the infrastructure just in computers, massive computers. But you got Grok, Tesla's Grok, but they're also having to build the power and cooling systems. So they're actually building out huge solar farms and energy solutions to power and cool these mega data centers. So there is going to be this astronomical delivery of productive services, which makes these markets much more productive, which is why I'm looking for something that is a layer removed from what immediately in the next 15-year outlook see an extinction event due to AI. Because I think that is 5, 10, 15 years out, we're going to start seeing serious white-collar jobs start to be removed. It's already very apparent in my daily life. And I'm probably using AI and reducing some of my costs across the board from down to 10% of what I was for some services because AI is so much more productive. And those are not the low blue-collar jobs where they actually have to go do things. These are the ones that are thinking for a living. These are the white-collar jobs. So it's going to be very interesting to see what happens. I don't think anybody should be sitting in fear. I'm not investing in AI growth. I'll tell you why. Because I also didn't invest in the .com bust. And because I did invest when real estate was booming, and I lost everything on the other side of it in the subprime mortgage collapse, right? So I don't invest speculation on timing the market. That's just not my jam. I'd rather be patient and win by being in a very reasonable, insulated position where I can get calculated risk-adjusted returns. And they say, don't try and catch a hot knife. I think AI is in the reverse of a hot knife right now, right? It's a burning hot razor going up that could fall depending upon what startup or you've been into. It could overnight, with how quickly the technology is growing, it could become obsolescent overnight, right? So I don't invest heavily into the speculation of AI. It's just not my jam. Done it before, don't like speculating. But I'm okay with investing into industries which are insulated from it and observing it. And I'm a geek by heart, right? I'm an engineer by heart. I love it and I use it all the time.
I'm thinking like the nuclear, the energy basically that is provided for AI, because I have investments in that as well. That's what I was hoping to hear from you. That's probably a good idea. It's kind of like a hedge against that .com bubble that we had back then. You're not really directly investing in AI. You're investing in the energy that is provided for AI. So that's what my thought was. That's how I think. For our listeners who wants financial freedom but feels overwhelmed, what's the first step they should take today towards investing?
Takes in life, and they all have different levels of education. Starting from the beginning, I created Passive Investing Mastery because there really is no place that I know of for people to go that's agnostic, that's not trying to funnel you into mobile home parks or trying to funnel you into some guru flipper program or tax deeds or something. We created PassiveInvestingMastery.com specifically to just agnostically present all the different kinds. So I tell individuals, you need to spend once a day, 10, 20, 25, 30 minutes if you can, once a day, just like going to the gym once a day. Work out your brain, your investing brain. You spend the majority of your life making money. How about spend 10% of your day learning how to invest it wisely? And listen to something. You're driving in a car. I run every morning and I listen to podcasts and ebooks and webinars. That's my time. Maybe you're doing the dishes, the laundry, whatever it is. Figure out some time where every single day you can take one passive step and you can begin to educate yourself, become more familiar with terms, listen to podcasts like these, My Mastery series. But then once a week, get on a webinar or get physically in front of people at least twice a month. But once a week, get on something where you're actually focused and you're not distracted. You're focused and you're learning about how a deal works, or you're getting on a meetup group and you're networking with other people. But one active step a week, and make at least 2 a month where you're physically in front of people, because that's when you will actually start to stretch yourself. You'll grow the most, you'll build the closest bonds. And it was in some of those early on meetings where I was awkward and not sure that I made friendships that I'm still friends with, people I'm still friends with today, many years later. And set a goal for yourself, because you don't really learn until you actually take a step out there. So set a goal for yourself in the next 90 to 120 days to actually make your first investment.
Gotcha.
That's going to drive a lot of your activity, right? Because you're going to need to start getting out there and learning. You're going to need to start getting out there in front of people and building a network, because you're going to make an investment. And set that goal for yourself and actually take action. And I think that's really what we help people do. Or what I try and help people do is get them educated enough to feel comfortable enough to begin to do that, and then provide all the options available.
Gotcha. Yeah, make that first step, guys. We talk about this all the time on this podcast, by the way. Everybody I interview, they just say, first steps first. You got to make that first step. That's it. Of course, education is really important, but don't get caught up in the middle of, I don't know enough, I don't know enough, I don't know enough, I don't know enough. Make that first step, because if you don't, you'll be stuck in the I don't know enough stage all your life. And because there's so much material out there that you could learn from, and so many different avenues. Pick one that suits you, that you like, and join in on the fun, and join us with Patrick and start investing. Patrick, what an incredible conversation. Patrick Grimes is a true leader in recession-resilient investing and a guide for anyone ready to build real lasting wealth beyond Wall Street. If you found value in today's episode, and I know you did, make sure to subscribe, hit that notification bell, and drop a comment on what part of Patrick's story inspired you the most. To connect with Patrick and dive deeper into passive investing strategies, visit PassiveInvestingMastery.com and follow him across social media. The links will be in the description below. And as always, I'm your host, Lancelot Lenard of the Sir Lancelot Group, reminding you, your network is your net worth, and education is your greatest investment. We'll see you in the next episode of the Real Estate Roundtable. Thank you, everybody.
Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.